Well, today we're going to talk about lower leverage and how it can help you survive and thrive as a trader. And to take a little bit of a step back, I suppose, what is leverage? Leverage is the amount of capital that you're going to be required by your broker to put down as an initial deposit to get a much larger position in an underlying market, or what we call the notional exposure. The lower the percentage that's being asked, obviously the higher the leverage that you're getting in that position. Now, of course, this came into force back in early August, where we saw ESMA making sweeping changes within the retail trading community to cap leverage in major FX at 30-1, minor FX at 20-1. We saw leverage restrictions being capped on indices at 20-1, gold at 20-1, and cryptos at 2-1 as well. And of course, this had big implications for retail traders. Some people will continue to trade as professional traders, in which case you have to have a certain amount of experience. You have to have a certain portfolio size that exceeds over €500,000. And also you need to have a trading knowledge as well, which means having worked in the professional financial services industry for a year and having some relevant experience within those products as well. We've seen a lot of clients moving over to that professional status, and perhaps that's something that may benefit your situation going forward. But there's also a lot of people who will now be capped at and have been capped at these leverage restrictions. And we want to have a look at today is how lower leverage can really benefit those people who are starting out on their journey, the people who are trying to create an edge in the market and apply their craft and really understand how they can survive for a long period of time before they can take that next step up. And that's what we're really looking at today, how lower leverage can be actually quite beneficial, how it can allow you to encourage the trading discipline that you need to be a trader and actually really make it in this industry, how you can get correct position sizing, actually stick to those correct position sizing, and ultimately how you can get the right exposure for your account size. We're not looking at someone who's got a £500 account and being able to get $200,000 worth of notional position on that, because that can work out really well for people if you get the right trade, but also it's a really good way of losing money very, very quickly if you get on the wrong side of the market, and of course that can happen. So when we're learning to create an edge, when we're learning to become a trader and we're trying to get a process, which we're going to talk about in a second, having that lower leverage really allows you to stick and encourages that discipline that is very much needed in that situation. So in terms of the trading overview, this is the process which I believe is really relevant for the hierarchy of actually concerns and considerations. Now, a lot of retail traders will not focus on these side of things, but I think this is the importance that we have at the moment. I think for me, if we're looking at risk management, that's really important. Trade management as well, position sizing, which I think is absolutely fundamental, and leverage plays a big part in getting the correct position sizing. Entry, probably not so much. Executing your process and how you've actually gone about adjudicating how your process goes. I'll talk a little bit about that in a moment. But when we're actually looking at leverage and the degree by which we can borrow to get a much larger position, of course this affects your risk management, it affects your trade management, it affects your position sizing, it affects how you think about the markets, it affects how you rationalize the market, and it is the all-encompassing situation. Because if you have a look at the main factors which professional and seasoned traders will look at as considerations for how confident they can be, the event risks that are in the market, how far they want their stop loss away from the market, how they adjudicate position sizing, which of course is really what trading is about. You are a manager of risk. Volatility is absolutely key. If you see high implied volatility or high realized volatility, you can see that through things like the average true range or through optionality. You've got that high degree of range that are coming through in the market. And if you combine that with very, very high leverage, 200, 500-1, and you're not adjusting your position size accordingly, well, of course, you're just compounding the issue. If you don't know what you're doing, if you haven't created a plan, if you haven't got an edge, when you have very, very high volatility and very high leverage, effectively you've got a recipe where you could be making a huge amount of money very, very quickly. But of course, you could be doing some damage to your account in that situation. So as a professional trader, as someone who's been in the market for a long period of time, we do look at how volatility affects position sizing, and it affects how much risk you can take on any one time. Now, if you compound that situation with very high leverage, that's where we have big considerations. Having low leverage in that environment, really gives you that discipline and takes a lot of the hard work out of that position, which of course is fantastic when you're learning to ply your trade. Of course, we can see other aspects which can cause big moves, and when we combine them with high leverage or lower leverage, these are big considerations. But how many people, when they're starting out, really think about positioning, whether it's futures positioning, whether it's positioning that's in the underlying equity market, for example, or whether it's options positioning. When you get the ship, too many people on one side, and you get that position unwound. When obviously that plays into your risk reward and the concept there. Of course, if you're holding a large position and you've got high leverage in that position, and you get an event risk that comes through, perhaps like the non-farm payrolls or a Fed meeting, for example, and your position is too big for the accounts, and effectively, you get a big move very, very quickly, that can see you making or losing a lot of money as well. So, of course, as savvy traders, we're always looking at how we can protect ourselves and the event risks that are coming up. And, of course, as you're learning out, having that low leverage means that you're going to be less exposed to that situation in the first place. So, for me, leverage is one of the most important situations, whether you're back testing a strategy, whether you're looking at new strategy. The amount of leverage that you're taking on in that product at any one given time, I think, is absolutely fundamental there. So having that lower leverage when you're starting your journey is obviously very key there. So let's put this into practice. I've got this spreadsheet here, which I suppose could look quite daunting when you're looking at that. But let's look at it on the top left-hand corner here. Let's have a look at a very simplistic trading process. I'm not going to go into huge amounts of detail about the trading process, but in any one given day, a trading plan might consist of identifying a trading opportunity, whether you're a scalper, whether you're a swing trader, whether you're a position trader, whatever you're looking for, breakout trader. The first thing you're going to do is identify trading opportunities when you're going to be staying on top of chart breaks, whether you've got them on high watch. The first thing you're going to be looking at is the trading opportunity. So leverage really doesn't play too much into that situation. You're looking at a higher probability outcomes in that situation, but it definitely becomes much more of a consideration when you get to point 2 here, assessing how much risk to take on. It definitely is a factor when you're assessing your position size accordingly. It's definitely a factor when you're understanding the reward factor. And then, of course, you're going into actually executing the trade. Do I want to leave limits? Do I want to trade at market? Do I want to buy higher levels in the case that you're looking for momentum to play through? It's probably less a consideration when you're actually in the position. You're managing the exposure, you're managing the risk that's in that position, and then, of course, once you've crystallized that profit or loss, having a full review of the process that you've gone through. And as a good trader, as a seasoned trader, you really want to tick all the boxes off and understand, how has this gone? How has my process gone? It's not just about making money. It's about sticking to a plan and sticking to it, thoroughly and reviewing yourself on that situation as well. So I want to have a look today at how leverage plays into a situation of how much risk we can take on, how we can assess position sizing and correct position sizing, which is, as I went back to that previous chart, is so important for me. Make sure that you've got the right position for your account and understand the reward factor. So if I go to this top box here, this section here, we're all pretty much taught when we first start trading that we want to understand how much risk we're taking on per position. And a lot of people will default to a situation where they're going to take 1 or maybe 2% of their account balance, which we can see here. I've chosen $1,000, which is a very popular amount that we see people looking to start their trading with. And people will always say, oh yeah, we're going to risk 2% of that position in that situation. Now, in terms of how far away we are with a stop loss, in this case I've given the stop loss 40 points away. I'm going for, I'm working on 4-hour charts, for example. I've looked at the average true range. I've looked at the sort of degree of leverage in the market, or degree of volatility in the market, and I've decided for whatever reason that I'm going to put my stop loss 40 points away. So the system here is giving me that I need to risk, that I'm going to be risking $20 effectively, which is 2% of my account. And given where my stop loss is, my correct position size now is I'm going to be looking to buy 0.05 of one lot. And that's really the correct position size. So when we're actually looking at point number 2, how much risk we're taking on, we're effectively taking 40 points of risk. I'm risking 2% of my account balance. And it's telling me that the system's telling me that the correct position size in this case is 0.05. Now that's fine. If we go down here and we have a look at euro dollar, we've seen euro dollar at this time is got a spot price of 113, the figure, or around about there. But of course I can change the asset class, and I can change this any one time. But I've gone for euro dollar. It's probably arguably the most traded currency pair that we see here. And we know that the correct position size for the account that we've got at the moment is $1,000. Of course, I can change this. We can have a much smaller account. We can change this to $500. And in that situation, we'd have 0.03 of a lot. We could have a bigger account and go for $10,000. And the correct position there is we're going to be going for 2.5 contracts in that situation. But let's go back to our $1,000 argument here. Now we can see with the leverage requirements in place currently that it's going to cost us within a $1,000 account $188 to get that one position on. So with the correct position sizing in the market, if we're going off what how I think most people should be trading, given the leverage in the market, given the distance to the stop that we've chosen, given how much risk we're going to be taking on, we're going to be putting down $188 for the position. So in theory, whilst we are getting a lower amount of leverage in the market, and some people would argue that that's undesirable, we can still get 5 positions on at any one go. So I might want to go and trade cable, I might want to trade dollar yen, or have a position in gold at the same time running concurrently with that position open. But at least I know that there's still enough leverage in the market at this point here that I'm going to put one position on with the correct size relative to the account size that I've got, that I can still get 5 other positions. Yeah, okay, fine, 200 to 1, I can get more positions at the moment, but I've still got even at 30 to 1, I've still got a notional exposure of $5,000. Now, for each point move, effectively I'm making 50 cents in that position, which I'm risking 0.05 of 1% or 5 basis points of my total account. And you can see that here. And that's just off 1 pip move. You can see that obviously those dynamics don't change, but the margin requirement will go up or down depending on how much leverage you've got in that situation. Now that's all good. That means we can still get a lot of trades on. We can still get 5 trades on for the correct position sizing. So we are still making that amount of money. If we are looking at say a 30-point move in the market on this correct position size, we can still make $15 on this situation within a $1,000 account, which doesn't sound like a lot, but if we're doing enough trades over time, what it does is it really facilitates the idea that we have skin in the game. And if we go down to point 3, the critical findings of leverage, what we're trying to do is the progression. We're trying to get the journey that we have. So we're going from that progression of a demo account, which is great. Demo accounts give us the sample size that we need. Let's say I'm going to go and do 50 to 100 trades on my demo account. I'm going to take it professionally. I'm going to actually not just punt. I'm going to try and hone my craft and do what I want to do in the real world. And when I've got actually a decent sample size, I can then actually adjudicate that. I can assess that to see if I have an edge. Where am I going right? Where am I going wrong? And then I can actually step up to a live account. The good thing about this situation with the live account is you are making real amounts of money. Okay, it's not a huge amount of money, but what we also see, and quite often, is people on higher leverage amounts making $15 per trade, or losing $15 per trade, but then suddenly having a run of wins and thinking that they're invincible and that their strategy is amazing, and then just coming out and deciding that they want to go and do, let's say, one lot. In this situation, in 200 to 1, you could still get the trade on, and you can see that you've got a notional exposure to the underlying market of 100,000 US dollars. Now, if you think about this, in that situation, if we've got a $1,000 account, and what we've been allowed to do is put on one full contract, a 10-point move in the market is going to give us a $100 profit or loss. Now that's fantastic. We've gone from making $15 and we've decided to ramp up our position because our strategy is invincible. We can't lose money. And then suddenly we have the euro dollar goes down by 10 pips, which isn't a lot. You can do that in a couple of moments, especially around announcements, which I've talked about. And you've just lost 10% of your total account on a 10 pip move. So what you can see here is this red mark showing that we wouldn't have been allowed to get the position on because our margin is over our account balance. We could have done that with 200 to 1, which is fine if you know what you're doing. but when you know what you're doing, you probably wouldn't have over-leveraged yourself, or you would have had a tighter stop in that situation. But we would have lost or made $100, which is 10% on one trade in a 10-point move in that situation. And so what happens with 30 to 1 is it means that we couldn't get that trade on in the first place. But we've still got a big enough position. I can actually change this around. I can take more risk on in the position, and I can still get. Look, I'm risking 5% now, and I've still got exposure to 12.5 grand, and I can still make or lose a reasonable amount of money by taking that up. And so what we do is we can see quite clearly there that having too big a position, when you can get that on with too high a leverage, can make you or lose you a lot of money very, very quickly. But what we're also trying to do with the critical findings of leverage is that experience should determine one's degree of leverage. So if you've been in the market for a period of time, you have that risk management strategy, you know how to control your stop loss, you may want that high degree of leverage. But I think when you're starting off, you can see you can still get a decent amount of positions. You can still get enough notional exposure on a 30-point move there. With a 5% degree of risk, we're still making or losing $37 off a 30-point move. That's 3.75% of your account. So that allows you to be fiscally responsible. It allows you to be prudent. We can see here I'm taking 5% risk on. An ATR, an average true range move, an average move in any one given day at this precise moment in euro-dollar is 70 points. So that's one day's move. At the point, we're risking 8.75% of our account. Now, if we go back to the example of having one contract size, which of course we can get on at 200 to 1, we're risking 70% of our account on one ATR move. So the average range over a 5-day period is 70 points. On one day, if we've over-leveraged ourselves in that position relative to the size of our account balance, we could have made or lost 70% of our account. You're not going to be surviving and thriving in that financial market in that situation. So that's where we go back to our example, and you can categorically see how this all works out. Now, in terms of the financials, I've had a look at, the required margin on that one position that we have there is going to be $470. The equity where that needs to fall before you get a margin call, and the amount of loss on that position to trigger a margin call. Now those dynamics obviously change with the amount of leverage that's involved as well, but that's what we can be seeing. So what we can see with leverage is that experience should determine one's degree of leverage. The more confident you are in your ability to take risk and trade around announcements and understand how volatility works, the more leverage that we want. But when we're starting out in our journey, when we've gone from demo account, you can still get that degree of leverage that we need. Low leverage can help with that progression from demo to live to professional status, which I think is absolutely key. Lower leverage limits the amount of total positions, but still gives us the good exposures that we need. So it doesn't allow us to have 100 positions on at one in time, but it does still allow us with the right position sizing, which I've talked about, to be able to get a number of trades still onto the position. It still allows us to have sufficient distance to our stop loss. If you want to have a 100-point stop loss or a 150-point stop loss and work off daily or weekly charts and look for a 300 move per point to the upside, lower leverage at 30 to 1 still allows you to do that. If we use correct position sizing, it helps us with that discipline, and we can still achieve those multiple positions using 30 to 1 as I talked about there. So when we're going into this, what we need to do is understand that we need to survive and thrive. The idea that after we've been in the market for a couple of years, we're going to be much more confident and have a much greater ability to be making profits longer term, and lower leverage will really help in that early days in that scenario, giving those $15 moves, those $20 moves here and there, before you have the urge, then the itchy trigger finger to suddenly go out and put buy or sell a full contract. And of course, in that situation, as we've demonstrated, you can make or lose 10% of your portfolio very, very quickly. So lower leverage can really, really help you in those scenarios there.